Hey everybody, with the stock market recently trading near all-time highs once again, it's very common that I get questions around, what does this mean for your investments? Should you make any changes? Do we need to be worried? Is a crash inevitable? And to help answer some of those questions, I wanted to bring back a popular episode from 2024 that talks about what history tells us about all-time highs and why you, optometrist, should continue to maintain the long-term investment plan that you've already put together. And with that, I hope you enjoy this rewind of our popular episode, Investing in All-Time Highs. Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Yvonne Mindrin, certified financial planner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening today. Really appreciate your time and attention. And today we're going to talk all about all-time highs, because earlier this year, 2024, we had yet another all-time high in the stock market. And this usually leads to this showing up in the news headlines as if it's something that you need to be aware of and do something about. The news headlines usually bring this to your attention as if it's something you really need to be focused on, concerned about. So what do all-time highs in the stock market actually mean for optometrists? Should you be fearful of all-time highs? Do they automatically mean that a decline is inevitable? As you might hear the phrase, what goes up must come down, as if there's some sort of law of gravity on the prices of stocks that forces them, drags them downward. Or as I've seen questions of, I have a lump sum to invest. Should I really be investing it at all-time highs? Well, fortunately, I'm here to tell you that an all-time high in stock prices isn't something you really need to be concerned about. And it definitely doesn't mean that a big decline is sure to come. All-time highs, when you look back historically, are actually pretty common. And we're going to talk mostly about the S&P 500 today, an index or a list of among the largest 500 companies in the United States. And it's definitely not the whole stock market, but most optometrists will be familiar with it. It's a pretty big chunk of the US market, and we have a lot of good data going back pretty far. So we're going to talk a lot about mostly the S&P 500 today. And with the S&P 500, since 1950, there have been 1,250 all-time highs along the way, which is an average of roughly 16 every year. And it ranges by decades. So 1950s, there's about 137 of them. 1980s, 189. 1990s, 310, a lot more there. 2000s, 13, not surprising. That was sort of that lost decade where the S&P 500 returns were pretty much flat. 2010s over 200, 2020s over 100. So it does vary by decade, but it's over that whole time period around 1,250. And it sort of stands to reason, just statistically, that we should expect to see highs in stock prices over time. The majority of years have positive returns, but stating that this is a usual occurrence doesn't get clicks, right? It's not going to force you to click into that article. Doom sells, unfortunately. So you won't see business as usual in a headline anytime soon. The concern you see, though, and the concern that's often sort of inferred, that's hinted at in a lot of these media pieces or sound bites or video clips, is that since prices are high, since prices have gone up, a decline is inevitable. That it's inevitable you're going to see poor returns from here on out. Get ready, right? Sell out. Now's the time. Something like that. That's usually what is going to be either explicitly or implicitly stated. But that's not necessarily the case. In fact, when you look at average returns after all-time highs, it's not what you would expect. Dimensional Fund Advisors has a piece that I'm going to link to in the show notes that looks at all monthly return data from the S&P 500 from 1926 through 2023. And they look at the average annual returns of the S&P 500 1 year, 3 years, and 5 years after months that ended at record highs. So we're looking at what happened 1 year, 3 year, and 5 years after a month that had an all-time high, after a record high. And as it turns out, all-time highs are followed by more record highs on average. That is on average, right? Not every time, but on average, that's the case. When you look at the data here, what they show is that after a record high, the average return 1 year later for the S&P 500 was almost 14%, 13.7%. 3 years later, the average annual return was 10.6%. 5 years later, the average annual return was 10.2%. Not too bad considering the scariness and doom and gloom that you tend to see around this. And even more, what's fascinating is that they compare this to the average returns 1, 3, and 5 years after months that ended on any level, meaning they compare what happens after record highs versus what happens if you invest on any given month. And there's no material difference between the two. 1 year after, the returns are actually 1% higher on average after record highs than on any given month. But 3 and 5 years later, they're within 1% difference. It's actually pretty close. Again, probably not what many of you may have been expecting. I think many expect poor performance in the short term, right? But history shows that that's not quite the case. That within a relatively short time period after all-time highs, 1 to 5 years later, that hasn't been this material difference in average annual returns versus any other given month on average. And so I hope this helps to kind of settle you down from any potential doom and gloom you might see out there. And I'm personally thrilled about all-time highs. Otherwise, why am I investing? It means that investors are doing well, likely that businesses and the economy is doing well. And since over time, stock returns tend to follow earnings, it probably means over time that businesses are profitable. But what about those declines? We talk about the average returns, but what about big corrections? How frequent are market corrections after all-time highs? And I'm going to link to data from RBC Global Asset Management in the show notes as well. This is only going from 1950 to 2023, so it's not quite as a lengthy time period. But what they find is that 1 year later, only 9% of all-time highs were followed by a decline of 10% or more. So only 9% were followed by a true correction. 3 years later, only 2%. And then 5 years later, 0%. So it actually has been very uncommon, at least in this data set historically, right? It's actually been very uncommon that all-time highs have been followed by a pretty substantial decline. Again, this is historical data. This does not guarantee that this is what's going to happen in the future. Past performance is not indicative of future performance, but it does give us a reasonable expectation for what might happen as these events occur. But that doesn't mean stock markets will continue giving you positive returns forever. There is some cyclicality to it. If markets are on an extended increase or an extended bull run, we should have some expectation that returns are going to pull back. I mean, simple math would suggest that if the average annual return is mid to high single digits or so, and that if returns are much higher than that, there needs to be some regression to the average. There needs to be some adjustment to that. We should not expect to have forever higher than average returns. So that does make sense, and that's part of investing. That's simply a part of investing. We are putting our money at risk. We are investing our dollars so that over long periods of time, it will outpace inflation and help us to meet our financial goals. And you're doing that without taking undue risk, but you are putting your dollars at some uncertainty and at some degree of risk. Declines are common. In fact, when you look throughout history, a 10% loss or so, you should expect on average every 12 months or so. There's probably an annual expectation of some low double-digit decline on average. 20% drops you might expect to see every 3.5 to 4 years. 30% or more drops, probably about once a decade. So these are things you're going to experience as long-term investors throughout your life. But since we are long-term investors, we're not really concerned about what our investments are doing on any given 1 day period or 1 year period, or realistically over a 5-year period. We're concerned about what our investments are going to do over the next 20 and 30, 40, 50 years of our life. That's what our return expectations are as we're investing for long-term financial independence. And so while it's not fun to go through these declines, we can benefit from them by staying invested and continuing to invest and seeing the likely rebound on the other side. And realistically, since we are long-term investors, all-time highs really aren't anything to take note of. I mean, it's not really anything to me, it's not newsworthy. It's not something I'm thinking about or concerned about or really talking to clients about. This short-term performance stuff is just not of concern to me because we are long-term investors. So what should we do? Well, ignore the noise, right? Ignore the media sound bites or headlines or video clips all about doom and gloom. Just kind of put that out of your mind. Most importantly, you want to focus on your own financial plan. What are your goals and what are the purposes for your investments? You want to have a sound, strategic, long-term mix of investments that fits your life and your circumstances and your investment goals. Having an appropriate mix between stocks and real estate versus bonds, and even within stocks and bonds, having a right appropriate balance of the different categories. Large and small stocks within the US and internationally, all the different characteristics of stocks. You want to have the appropriate long-term mix of investments that fits your circumstances and your investment goals. And then simply stay invested. Taking less action is most likely going to be the best course of action. And only doing that normal maintenance, such as rebalancing, that is trimming the categories that are too high relative to your target, and then adding back to the categories that are lower than you're targeting, ultimately to maintain your risk long-term, or tax planning opportunities in non-retirement accounts. Those things are normal maintenance that are appropriate, but for the most part, simply stay invested and then focus your efforts, your energy on the things that are actually within your control. Your job and your career. If you own a practice, focusing on your practice or other businesses. Focusing on your savings rate, how you use your cash flow, how much of your income are you turning into assets by investing. Those things are where it makes sense to put your additional time and concern and stress and energy. And hopefully this is helpful to give you some context around these record highs as they come throughout your investing career. And as you see, again, the headlines and the sound bites about this, and as you have questions about, man, I've got this money, should I really be investing it now? And what's fascinating is that although many are concerned about investing at all-time highs, people are just as concerned when prices are declining and prices have declined and these things go on sale. So whether prices are high, whether prices are low, there's always going to be some reason for concern. But stay focused on your goals and on your long-term investment strategy and try to just push the noise away. If you have any questions or ideas or questions for future episodes, maybe we'll have a mailbag episode coming up soon if we have enough questions. You can reach me here at podcast@optometrywealth.com. You can check out the links I mentioned and resources mentioned in the show notes, which you can find at the Education Hub at my website, www.optometrywealth.com. And while you're there, feel free to check out all of the other articles and resources and episodes we've done, as well as schedule a no-commitment introductory call. We can talk about all of this fun stuff and anything that's on your mind financially, and I can share how we serve optometrists navigate their most important financial decisions nationwide. And with that, we'll catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Yvonne's website at optometrywealth.com. Yvonne Mindren is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Yvonne and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.